There's something people don't talk about enough when it comes to celebrity brands. The face you see on the bottle isn't always the person running the company. And when things start going wrong, that distinction suddenly matters a lot. For years, the public narrative around Blake Lively's beverage brand has been simple. She's the founder, she's the creative force, she's the woman behind a clean, premium mixer company built on real ingredients and sustainable packaging. It's marketed as thoughtful, elevated, and woman-led. But once you start digging into the corporate structure behind the brand, that story becomes much more complicated. The company at the center of this is Betty B. Holdings, which oversees the beverage lines. It isn't a one-person operation, it's a collection of holding companies and investment entities tied together under layered ownership. Among them are iPen Holdings LLC, LOL Hada, the entity associated with Blake and Ryan, Bellfleur Capital Partners, Graver Fusa LLC, and ACG Buzz LLC, along with other admitted stakeholders. This isn't a small founder-run startup, it's a structured investment-backed operation. Blake Lively and Ryan Reynolds are not simply symbolic supporters, they are officially listed as talent managers for the company, and their entity, LOL Hada, holds a minority stake. The operational management, however, includes executives like Andrew Kazmalis and other board-level members. The board itself is largely composed of investors and business operators, not just the celebrity faces associated with the brand. And that's where things start to shift. Because when you look at how the ownership is divided, it becomes clear that Blake and Ryan did not put in the most capital. They contributed approximately $2.1 million for roughly a 30 to 32% stake in the company. Meanwhile, iPen Holdings reportedly invested around $15 million and received about 25%. In other words, the largest financial backer did not receive the largest percentage. Why? Because the value being purchased wasn't just inventory or production, it was celebrity equity. Their faces, their names, their reputations. The investment model here is familiar in modern celebrity branding. Investors supply the capital, the celebrity supplies the visibility. The implied agreement is simple. Your public image is an asset. Protect it, grow it, monetize it. But buried inside the company's governing documents is something that raises serious stakes, a morality clause tied specifically to Ryan Reynolds' conduct. The language doesn't require criminal wrongdoing, it doesn't require a conviction. It states that if an act is reported by major reputable publications and justifiably shocks or offends a significant portion of the public, particularly in markets like New York or Los Angeles, and causes a material and lasting adverse effect on public image, the board may remove the individual as a manager. That's critical, because it means reputation isn't just about public perception, it's contractually tied to control of the company. If the board determines that public backlash materially harms the brand, they can vote, without Blake or Ryan's vote included, to remove them from management positions. Their stake doesn't automatically disappear, but their power and influence can. And remember, this clause doesn't hinge on criminal guilt, it hinges on public reaction and media coverage. Now place that into context. During the promotional cycle for the film It Ends With Us, Blake Lively heavily integrated her beverage brands into the press tour. Promotional tie-ins appeared, drinks were offered during interviews, after-parties featured branded beverages, campaign messaging leaned into wordplay tied to the film's title. At the same time, online criticism intensified over tone, branding choices, and associations that some viewers found insensitive. Whether one believes the backlash was fair or exaggerated isn't the point. The key issue is contractual exposure. When your equity stake is built on the commercial value of your public image, controversy becomes more than just a PR headache. It becomes a corporate risk factor. And here's another important detail. Blake and Ryan are minority owners. They do not hold majority control. The board has the authority to act independently of them in specific circumstances. The larger financial contributors have fiduciary responsibilities to protect their investments. If the brand suffers measurable harm tied to reputational fallout, they are obligated to evaluate it. This structure also complicates another narrative: damages. If a company is owned by multiple entities and investors, and the celebrity figure is a minority stakeholder, how do you quantify personal reputational damages separately from corporate performance, especially if both are contractually intertwined? Because the reality is this: Betty B Holdings was never solely Blake's company. It was a consortium-backed enterprise where celebrity branding functioned as leveraged capital. And when celebrity capital fluctuates, so does the company's valuation. That's where the deeper financial story begins to unfold. When you move past the ownership structure and look at performance, the numbers tell a very different story than the public branding suggests. Betty B Holdings began selling non-alcoholic products in 2021, later expanding into alcoholic beverages in 2023 through a separate subsidiary structure. The decision to split entities, one for non-alcoholic mixers and another for alcohol, was reportedly about maintaining clean corporate reporting lines and separating product categories. On paper, that's standard business practice, but performance projections versus reality reveal strain. Internally, the company had projected ending a recent year at approximately 200,000 cases sold. Instead, they landed closer to 125,000 cases. That's not a small miss. That's a 37% shortfall against expectations. And when questioned about whether this underperformance was tied to recent controversy or negative publicity, the response was direct: no. The brand had not successfully broken into the dominant market share long before any alleged smear campaign. It had spent roughly 3 years attempting to establish itself in the premium mixer category, but remained behind major competitors like Fever Tree and Q Mixers. The internal language used was even more telling. Product market fit at scale was described as unclear. That phrase carries weight in investor circles. It signals that while a brand may generate initial buzz or niche traction, it hasn't proven it can scale sustainably in a competitive environment. And this is where expectations collided with financial reality. The company had ambitious growth projections, visions of becoming a major acquisition target for a large beverage conglomerate. This mirrors the celebrity brand playbook we've seen before: build visibility, generate premium positioning, and eventually sell to a larger corporation for a significant buyout, often structured with stock-based payouts and performance incentives. But there's a prerequisite for that strategy: strong upward growth trends. Instead, financial disclosures show losses. At the end of 2023, the company reported a net negative income of approximately $446,000. After expanding into alcohol and increasing capital infusions in 2024, losses deepened to around $3.4 million. Blake and Ryan's entity reportedly received zero payout during these periods. In fact, they contributed additional funds and even covered minimum tax obligations despite no profits. That matters because it undermines the assumption that this brand was a cash machine suddenly derailed by bad press. The company was operating at a loss before peak controversy. And internally, executives acknowledged they had not meaningfully eroded the market share of established competitors even after several years. In other words, the uphill climb wasn't new. So if the growth wasn't meeting projections and the company wasn't profitable, why maintain the aggressive branding push? Because valuation in celebrity-backed startups often depends less on current profits and more on future narrative. If you can demonstrate accelerating momentum, you attract acquisition interest. If you secure a buyout from a multinational beverage corporation, that's when founders and celebrity partners potentially see significant returns, often through stock and performance-based agreements rather than upfront cash. The gamble here appears to have been that Blake's image, combined with Ryan's marketing ecosystem, would generate enough visibility to push the brand into that acquisition lane. And Ryan's marketing machine is not incidental. His company, Maximum Effort, has played a role in marketing operations connected to the beverage brand, with incentive structures tied to performance. That creates an interconnected ecosystem: celebrity face, marketing engine, investor capital, all working in tandem. But interconnected systems amplify risk. If public sentiment dips, it doesn't just affect Instagram engagement. It impacts projected case sales. It influences retailer confidence. It shapes investor patience. And if performance stalls while controversy rises, the board isn't evaluating feelings, they're evaluating return on capital, which leads to an uncomfortable possibility. If losses were mounting and scaling remained uncertain, and if reputational damage added another layer of instability, the investor's tolerance window could narrow quickly. Because at that point, it's no longer about brand narrative, it's about fiduciary duty. Once you understand the ownership structure and the financial trajectory, the legal battle starts to look less like a simple reputational dispute and more like a high-stakes financial defense. Because here's the uncomfortable reality: if a company is already underperforming, and if the celebrity faces tied to its valuation experience public backlash, investors may begin asking hard questions. And those questions don't revolve around headlines, they revolve around contractual obligations. Blake and Ryan's stake in the company was built on image equity. Their 30+% share wasn't based on outspending other investors, it was based on brand power. That means their value to the company was directly tied to public favorability. When you layer that over the morality clause, where reputational harm reported by major outlets and causing material adverse impact can justify removal, you begin to see why public narrative matters so much. If investors can argue that reputational damage materially harmed the brand, they have structural leverage, and the performance numbers don't provide a strong defense. Losses of roughly $446,000 in 2023, followed by a $3.4 million loss in 2024, indicate that profitability wasn't around the corner. Internally, executives acknowledged they had not meaningfully penetrated dominant competitors' market share even after several years. That creates a vulnerability. If the company was already struggling to scale, and if controversy then compounds retailer hesitation or consumer pullback, investors may not distinguish between organic stagnation and reputational drag. They simply see declining projections. Now consider the broader strategy. The long-term goal appeared to mirror other celebrity exits: build brand visibility, increase valuation, and eventually not damage caused. Why does that matter? Because if investors believe the celebrity partners breached their duty to maintain brand image, they could argue breach of contract. If the morality clause is triggered, removal from management becomes possible. In extreme scenarios, disputes over damages and indemnification could follow. From a financial survival standpoint, redirecting blame away from internal decisions position for acquisition by a larger beverage conglomerate. That kind of deal typically hinges on upward momentum and clean public optics. But acquisition interest weakens when growth stalls. And this is where the lawsuit narrative becomes strategically significant. If reputational harm can be attributed to an external smear campaign rather than personal conduct, that shifts liability. It reframes losses as damage inflicted, and toward an outside actor changes the equation. It protects against the narrative that leadership itself compromised valuation. And then there's the perception layer. Publicly, the company has been framed as woman-led, but corporate filings show intertwined ownership with Ryan Reynolds' entities, marketing infrastructure, and shared investment vehicles. His marketing company plays a role. His business ecosystem overlaps. The branding may emphasize empowerment, but structurally, it is a joint enterprise. That matters because lawsuits seeking reputational damages often rely on the idea of personal harm. Yet when the business is co-owned and contractually bound to image performance, separating personal reputation from corporate outcome becomes legally complex. And here's the final tension point. The company wasn't distributing profits to Blake and Ryan during loss years. They were contributing capital into a business that had not yet delivered returns. That means their upside was still speculative, dependent on future growth or acquisition. If that growth path narrows, the pressure intensifies. So the central question becomes this: is the legal fight about vindicating reputation, or is it about protecting valuation? Is it about clearing a name, or about preventing contractual consequences tied to that name? When celebrity equity is the product, image isn't just marketing, it's collateral. And if that collateral weakens while financial losses mount, the stakes aren't emotional, they're structural.